Hey there, folks. Mitch Firestone. And I want to go through a couple of things here on this chart of eBay. Originally, I was going to just talk about one simple thing about sort of analyzing the chart and assessing risk and reward, and I'm certainly going to do that. But then I realized there's something else interesting that I can show you here as well, so I'm going to go into that in a couple of minutes too. But anyway, the initial focus here was this supply zone that I'm about to show you here. So we're looking at a daily chart here. We have a rally, a base, and a drop here. I, you know, price leaves here kind of with a red, pretty long red, long bearish candle here. There's a little pause here, and then it kind of then zings down a bit more. So I'm actually liking this setup. I like the fact that this is a reversal pattern here. It goes a reasonable distance away, and I'm also liking that as price is coming back to this level, it's coming back in a relative direct fashion. It's not kind of kind of going up and down. It's kind of making sort of a beeline there, and so all of that in a sense is good. But the one thing that I am noticing here, and that gives me some pause, is this pause right here. And if you notice in this gray circle, price has come up here. Notice it's now kind of leveled off here. And so if price comes back here and kind of then starts to head up, that's going to kind of ruin this setup, because essentially what we're going to have in front of this supply zone up here is a rally, a base, and a rally here, and that's going to be a pretty short distance away. And in a sense, if we look at it, and I kind of just project out what the trade would look like if we were going to short this, this is what it would look like. And I looked it up before, and I would basically be giving this about another dime of wiggle room, so which would mean that the stop would be sitting at around 40.95, 40.96. Okay, so that's basically right there. Okay, so if we were looking at this trade would barely go 1-to-1. And so you might look at this and go, well, okay, so this kind of ruins the trade, so why is he showing me this? And the reason is that this issue is not yet decided. And even though we have a rally, a base, and a rally here, or a potential rally and a base, and then if it does continue like this, if it just sort of continues up like that, then yeah, what I just said is going to be true. This trade effectively is going to be ruined. But the thing is, when you see something like this, okay, if all of a sudden, let's say it's doing what it's doing now, but let's say let's just say all of a sudden it kind of drops like this and then heads back up again from here. Well, then at that point, more or less, this is kind of negated, because once price drops below here, then this just becomes noise, because this is no longer it's a rally, a base, and it effectively becomes a rally, a base, and a drop here. And so this is not going to get in the way of a trade. So when you see something like this, after you get over your initial disappointment, if in fact that the pattern really hasn't formed, then you should still set an alert in your system and see exactly what happens, because in fact future price action may in fact negate this. And so I just kind of wanted to share that with you, because in a sense a lot of times you might kind of look at this and go, well, all right, this is kind of ruining my setup, so on to the next. But in fact, it may not necessarily be true. So again, if price would end up dropping here and then starting to head back again, well, then this all becomes noise here, and then this no longer becomes an impediment. Okay, so I just wanted to kind of share that with you. Okay, now the other thing that I wanted to show you is this. If you notice in here, I've got Bollinger Bands sitting in the chart here, and I oftentimes like to see them. Not that I would necessarily be trading. Not that I trade off of them at all, but I look upon them as both a screening tool in terms of helping to direct my eye to place where price is stretched in one direction or another, and the other thing is, in a sense, it becomes in a sense an odds enhancer, because if price ends up coming back to a supply zone here and it also happens to be intersecting with, let's say, the upper Bollinger Band, well, then that would strongly suggest that not only are we at a quality supply zone, but also price in a statistical manner is very stretched. And if you do any, if you can look this up, just go to any kind of, any website where you can just kind of get a reasonable explanation of Bollinger Bands. But the standard Bollinger Band is made up of a midline, which is a 20-period simple moving average, and then above and below are lines that, of course, parallel this, and that they are specifically that the default setting is 2 standard deviations away from the midline, okay, the moving average. So if something is 2 standard deviations, from a statistical standpoint, each standard deviation implies a confidence interval of where a particular data set is expected to be above or below. And so if you're looking at something that's 1 standard deviation away, there is an implication that there is a 63% likelihood that a data set will reside in between the 1 standard deviation above and 1 standard deviation below the midline. So that's 1 standard deviation, and that's a 63% interval. Well, that's not all that impressive because effectively that's not even really 2 out of 3. So obviously, if you're looking for something that's is gonna stand up to have some statistical rigor, you'd like to feel that it's better than 2 out of 3. Okay, so 1 standard deviation isn't all that impressive. So the standard that's used is 2. Okay, and if you look it up, you'll see that 2 standard deviations implies a 93% confidence interval. Okay, so now all of a sudden you're better than 9 out of 10, and in fact you're actually a couple of ticks away from really 19 out of 20. So that starts to sound a lot more interesting. Okay, so 2 standard deviations, but in fact. The indicator, the Bollinger Band, that's the way it's set up on a default basis. So it's set up 20 with the 20-period simple moving average as the midline, and then the Bollinger Bands are set at 2 standard deviations. But it doesn't mean that you are actually limited to simply what the default is. You can actually set up custom ones on your own to effectively give you sort of even, to give you another indication of something. So in fact, in this particular workspace that I have, in fact, what I do is I actually have 2 other sets of Bollinger Bands that I can overlay at any moment. So this is the standard one at 2 standard deviations, but I can actually I also have others that I can overlay simultaneously, which are 2.5 standard deviations and 3 standard deviations. Well, once you get to the 3 standard deviation, you go from a 93% confidence interval to a 98% confidence interval. So if all of a sudden you've got a 3 standard deviation Bollinger Band that's intersecting with a supply zone, excuse me, or a demand zone, well, at that point, now all of a sudden, from a statistical standpoint, there is a strong suggestion that price is really, really, really stretched, and that it should, a large percentage of the time, start to regress back towards the mean. Okay, so that's the implication. Again, I would never directly trade off of the Bollinger Band, but if all of a sudden that Bollinger Band is intersecting with a quality supply or a demand zone, well then for me that becomes an odds enhancer. So what I have in my workspace is this. So if you notice right here, you can see that I got three Bollinger Bands. So if you look close, you'll see right here. This is this one in the middle here is showing the 2 and the -2. But if you notice here now, I've got 2.5 and -2.5, and here I got 3 and -3. And so consequently, if I turn these other ones on, like this, well now all of a sudden I've got all 3 of them sitting here. So right here, this is a 2% band, this is a 2.5% band, and this is a 3% band. And then similarly on the downside, this is -2, -2.5, and -3. So at the point where this thing, let's say, intersects with this supply zone up here, I don't exactly know how price is going to move, and maybe this thing will just be, it'll come up and it'll be hugging the 2 standard deviation, and that's fine. But on the other hand, depending on when this occurs, this may end up, moving down and then starting to head back up. And so at the point where it intersects, it could be at either 2.5, could be at 3. And so to me, if all other things being equal, if I'm going to be, firing off of a supply zone there, um, and if it's a choice of having it being at 2 or being at 3, well, generally I'd much rather see it at 3, because at that point it's even more stretched, and from a statistical standpoint, it's more likely that the trade is going to work. So at any rate, you can set this up in your platform. So, and depending on how your platform is arranged, in certain cases, you could just manually have 3 sets of Bollinger Bands, and in certain platforms, including TradeStation, you can set up what are referred to as analysis groups. And what they are is when you click on an analysis group, it'll actually overlay any number of indicators or oscillators or moving averages or whatever you might have, and it'll just kind of do them as a group, so you don't manually have to do that. So for your particular platform, you should check and see what the conveniences that you have available are, and you can move accordingly from that. But again, but again, you should set up a one specific one specific workspace, one specific chart, and overlay the 3 Bollingers, and this way you can just kind of have them. So at any point when you have something that's really stretched, and let's say it goes beyond the second Bollinger Band, when it goes beyond your standard Bollinger Band, you can actually see, in fact, how far away is it? Because then you'll see, does it intersect with the 2.5? Does it intersect with the third? And who knows? If it's sitting even above the third, then something is just really just incredibly stretched there. So, but again, this will give you kind of visual evidence of all that. So anyway, so that's the takeaway here. So one, again, set up another set of multiple sets of Bollinger Bands in one place, just so you can kind of get a feel for when you see something that's really stretched. You'll have a better idea of it. And then again, the other thing is when you see an approach back to your zone, if in fact price makes a right turn and threatens to ruin your trade, don't just immediately tip over your king and resign, but in fact understand what you need price to do in order for that to negate the potential thing that's going to ruin your trade. So anyway, there you have it. That's what I got. Hope you found it interesting, and I will catch up with you guys soon. Thanks.